This course is Derivative Securities. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. Today we will cover the chapter on interest rate futures from the excellent text Options, Futures, and Other Derivatives by John C. Hall. One of the complicating issues when dealing with debt instruments are day count conventions. Day count conventions vary from type of securities and are somewhat complex to deal with when calculating different types of interest rates. For example, for Treasury bonds, you use the actual number of days over the actual number of days in periods. So for non-leap years, you would have 365 days. For leap years, you would have 366 days. Corporate bonds, on the other hand, assume a 360-day old-style lunar year, with each month having 30 days, including February. Money market instruments use the actual number of days on the top, but only 360 on the bottom. So you have 365 out of 360 days in non-leap years. For example, consider a bond with an 8% interest rate, actual over actual, and it pays 4% between coupon payments, meaning it pays twice a year. When coupons are paid on March 1st and September 1st, you could ask the question, how much interest is earned between March 1st and April 1st? This kind of question is addressed in another accompanying YouTube video. This is one of the more complex chapters out of the Hall text, so there are lots of other YouTube videos that address in more detail many of the slides, including this one. You could ask the same question for a bond. Now it would be a corporate bond paying 8% with the 30-360 convention, so you assume 30 days per month in a 360-day year, and ask when coupons are paid on March 1st and September 1st, how much interest is earned between March 1st and April 1st. And again, what you will have to do is count off a calendar the actual number of days to do the calculation, or as shown on the other videos, there are online programs that can find the number of days for you. The third example is T-bills, which would use the actual number of days on the top over 360 days on the bottom. And again, you would be asked under this circumstance how much interest is earned between March 1st and April 1st. One of the most interesting effects in this is the so-called February effect. And we could ask how many days of interest are earned between February 28th, 2015 and March 1st, 2015. If you use actual over actual, there are only 28 days in February, so you would only have one day. Whereas if you use the convention of every month having 30 days out of 360 days, you actually earn 3 days, because you have February 29th and February 30th, which are earned even though they don't really exist. And the United States Treasury bill prices are handled strangely, like many things involving bonds. Looking at this equation, P is the quoted price, N is the number of days to maturity, and Y is the cash price out of 100, so they normalize our Treasury bills to being $100, even if they're $1 million, whatever. So we could ask, for example, if it is a 90-day Treasury bill with a cash price of $96, you would do the calculation 100 minus 96 is 4, 360 divided by 90 is 4, and you would end up with $16 for the quoted Treasury bill price. So Treasury bills are very short-term, and Treasury bonds are long-term, 10 to 30 years. Again, there are strange ways of quoting them that aren't necessarily the price you pay for them. So we have a cash price, and that's going to be the quoted price. But unless it's on a day when interest was just paid, the cash price and the quoted price will not be the same. Instead, you will have to add accrued interest to the quoted price to get the cash price. This creates even more complications for Treasury bond futures, which are one of the most complex questions in this chapter and throughout the whole text. We could say the cash price received by a party with a short position on a Treasury bond future is going to be the most recent settlement price times a conversion factor plus accrued interest. And again, the details of these kind of calculations are addressed in another accompanying YouTube video. But here is a simple example. Let's say the most recent settlement price is $90. The conversion factor of the bond delivered is 1.38. Accrued interest is $3. So the price received for the bond is the conversion factor times the settlement price plus $3, or $127.20, assuming $100 of principal. The conversion factor is designed to convert the value of your bond to the value of a 6% semi-annual compounding bond, and each bond has a conversion factor for the purpose of bond futures, because for a bond future you can deliver a whole variety of bonds, and you have to do something like this to make sure that you have a reasonable amount of liquidity in the bond that will be delivered. By convention, Treasury notes are debt instruments that last from 1 to 10 years. Treasury bonds are debt instruments that last from 10 to 30 years, as opposed to Treasury bills that last up to 1 year. Both T-bonds and T-notes are covered under the Treasury bond futures contract. There are several features in the Treasury bond futures contract that favor the short side, or the side that has to deliver the bond. And of course, these can to some extent affect the Treasury bond futures price. One of these is the bond delivery can be made anytime during the delivery month. And of course, any of a range of eligible bonds can be delivered. The value of the bonds delivered then has to be converted using the previously mentioned conversion factor, and there's always going to be a so-called cheapest to deliver bond. Under the rules of the CBOT, trading in the Treasury futures market is terminated at 2 p.m. every day, but traders that have sold Treasury futures are not required to settle their contracts until 8 p.m. that evening. And of course, there are after-hours trades. So they have a 6-hour time period in which the value of the bonds can change, but the delivery price has been predetermined. Taking advantage of this is the so-called wild card play. So bond futures are long-term futures. Euro-dollar futures are shorter-term debt instrument futures. So a euro-dollar is a dollar deposited in a bank outside of the United States, and there are more dollars outside the United States than inside the United States. Euro-dollar futures are futures on the 3-month LIBOR rate. So Fed funds is overnight. LIBOR, there are several LIBORs, but the futures are on the 3-month LIBOR. And then, of course, bonds are long-term, 1 to 30 years. So one contract on a euro-dollar future is on the rate earned on $1 million, and they are structured so a change of 1 basis point, or 0.01, in the euro-dollar futures quote corresponds to a contract price change of $25. There is no debt instrument underlying the euro-dollar, so a euro-dollar futures contract is settled in cash, whereas a bond future is settled by delivery of the bond. And when the euro-dollar futures expires on the 3rd Wednesday of the delivery month, the final settlement price is 100 minus the actual 3-month LIBOR rate at that point in time. So the euro-dollar market is huge. In 2016, the euro-dollar market size was estimated at close to $14 trillion. And here is a list of the growth in billions of 2020 dollars of the euro-dollar market and different sources. And you can see here in orange our euro-dollar sources coming from 8 key European markets, and the bottom line is euro-dollar sources coming from outside 8 key European markets. And both of these are extremely large markets. Here are examples of euro-dollar quotes. So the interest rate paid would be 100 minus whatever the quote is. So for the first one, 100 minus 97.12 would be an interest rate of 2.88%. The second one, 100 minus 97.23, would be an interest rate of 2.77%, etc. And as the quote changes on a daily basis, you would have a marking to market process on euro-dollar futures. So for example, suppose you take a long position in a contract on November 1st, the contract expires on December 21st, and the prices are as shown on the previous slide. So on November 1st, it was 97.12. And we could ask questions, how much do you gain or lose, on the first day, on the second day, over the whole time until expiration of the contract, until it is at 97.42. Suppose you take a long position in a contract on November 1st. The contract expires on December 21st. The prices are as shown on the previous slide. And we could ask the questions, how much do you gain or lose on the first day, on the second day, and over the whole time until expiration? We will go into this in a little more detail on a separate video, but here we will answer some of these questions. So on November 1st, you know that you will have $1 million to invest for 3 months on December 31st. The contract locks in the November 1st rate of 2.88%. So the total interest on this is going to be the 2.88%, or 0.0288 divided by 4, since it's a 3-month rate, times the million, or $7,200. So this is how much interest you will earn on 3 months, starting sort of December 21st on that $1 million. But this profit is going to be split into different components. So on November 2nd, the price is 97.23, and on December 31st, the price is 97.42. So it keeps going up, or the interest rates keep going down. So in this example, the actual interest rate you're going to get if you invest on December 31st is 100 minus the 97.42, or 2.58% on your $1 million for 3 months. So that's going to be $1 million times 0.0258 divided by 4, or $6,450. We're going to make up for the difference between the 7,200 and the 6,450 by the daily marking to market process on the euro-dollar futures contract. So during this time period, as the contract price changes from the 97.12 to the 97.42 at the end of the contract, then we will make the difference between these two times 100 times 25, or 30 times 25, or $750. And if you add the 6,450 to 750, you get the total locked-in interest rate of 7,200. You're just making it in the actual interest on the investment plus your profit on the futures contract. Your first day's profit, your first marking to market profit in this example, will be 97.23 minus 97.12 times 100 times 25, or $275 out of the total 750 on the first day. The contract value, as always, is a strange, confusing formula. So if Q is the quoted price on a Eurodollar futures contract, the value of one contract is 10,000 times 100 minus 0.25 times 100 minus Q. So this is going to correspond to $25 per basis point change, or the 10,000 times the 0.25. Eurodollar futures contracts can last as long as 10 years. For Eurodollar futures lasting beyond 2 years, we cannot assume that the forward rate equals the futures rate. As we saw here, futures are settled daily, so you have a marking to market process. You get paid or lose money every day, whereas the forward contract, if you signed one, would only be settled on the day of expiration. So since the futures are settled on a daily basis, you receive money and you can reinvest that money every day at an interest rate. Futures is settled at the beginning of the underlying 3-month period. A forward rate agreement is settled at the end of the underlying 3-month period. Therefore, if you're going to compare these two, you have to add a so-called convexity adjustment to take into account if interest rates go up, you get paid on the futures contract every day, and you can reinvest that payment at a higher interest rate. If interest rates drop, then you will get a lower interest rate, either the short or the long, on that reinvestment of the daily marking to market process. The way this convexity adjustment is taken into account is you say the forward rate equals the futures rate minus 0.5, the standard deviation or volatility squared of the interest rate times T1, the time at the beginning of the contract period, times T2, the end of the contract period, which will always be 90 days later than T1, since all of these contracts are for 3 months. Here are examples of convexity adjustments. So let's say that the standard deviation is 0.012, and we are looking at a maturity of 2 years. Then our convexity adjustment is going to be 0.5 times 0.012 squared times the beginning T1, 2 years, times the ending time period, which will be 2.25. And if we multiply that out, we get 0.000324, or approximately 3.2 basis points. Doing the same thing for a 4-year contract, you get 12.2 basis points, and a 10-year contract, you get 73.8 basis points. LIBOR deposit rates define the LIBOR zero curve out to 1 year. Beyond this, Eurodollar futures can be used to determine forward rates, and the forward rates can then be used to bootstrap the zero curve. Again, there is another accompanied YouTube video that discusses the bootstrap method in a lot more detail than this one, but we will give one example. The other video derives this formula for you. The futures rate is the interest rate at time 2 R2 minus the interest rate R1, the initial time period, times T1 over time 2 minus T1. This can be rearranged and solved for the interest rate R2, which will then equal the futures rate times T2 minus T1 plus R1 T1 over T2. So for example, if the 400-day LIBOR zero rate has been calculated as 4.8%, and the forward rate for the time period between 400 and 491 days is 5.3%, the 491-day rate is going to be 5.3 times 491 minus 400 are 91 plus 4.8 times 400 over 491 are 4.893%. And again, this has gone into more detail in another video on the bootstrap method. Duration matching is a common method of risk management for banks. This involves hedging against interest rate risk by matching the duration of assets and liabilities. So in the case of a bank, the liabilities would be deposits, the assets would be the loans, and it's very common for banks to finance long-term loans with short-term liabilities. Duration matching provides protection against small parallel shifts in the zero curve. An example of when banks and particularly savings and loans did not do this very well is the late 70s and early 80s financial or savings and loan fiasco when many savings and loans went bankrupt. They went bankrupt because the yield curve became inverted and short-term interest rates that they were paying on the deposits went up drastically, while the interest they were being paid on their loans did not. This is again discussed in detail in another accompanying video. How do you use Eurodollar futures to hedge? Well, one contract locks in an interest rate on $1 million for a future 3-month period. We could ask how many contracts are necessary to lock in an interest rate on $1 million for a future 6-month period. And the answer would be 2. You basically need a contract per each 3-month time period. Duration-based hedging must be corrected using a hedge ratio because the duration of what you are going to hedge is not necessarily going to be the same as the duration of the hedging instrument you use. So this hedging ratio would be defined as P D sub P, V sub F, D sub F, where P is the value of the portfolio being hedged, D sub P is the duration of the portfolio at hedge maturity, VF is the contract price for interest rate futures, and DF is the duration of the asset underlying the futures at maturity. Let's look at an example involving hedging using Treasury bond futures. It is August. A fund manager has $10 million invested in a portfolio of government bonds with a duration of 6.8 years and wants to hedge against interest rate moves between August and December. The manager decides to use Treasury bond futures that expire in December. The futures price is 93 and 2/32, or 93.0625, and the duration of the cheapest to deliver bond will be 9.2 years at the futures contract maturity. The number of contracts that should be shorted is then the $10 million that's invested times the duration of that portfolio of 6.8 years. Each Treasury bond futures has a contract value of $100,000 of the face value, so 93.0625 of that would be $93,062.50, and the cheapest to deliver bond has a duration of 9.2 years, so the number of contracts that should be shorted is 79. There are limits of duration-based hedging. One of the biggest problems is it assumes only parallel shifts in the yield curve, and of course yield curves don't just go up and down, they become steeper or flatter. It assumes that the yield curve changes are small, and when T-bond future is used, assumes there will be no change in the cheapest to deliver bond. There are ways of doing more complicated hedging mechanisms. One of them is gap management. So this is a more sophisticated approach used by banks to hedge interest rates. Rather than looking at the entire yield curve, you split the yield curve into buckets, 1 year, 2 year, 5 year, 10 year, etc. And you hedge the exposure to situations where rates corresponding to one bucket changes and all the other rates stay the same. Interest rate risk is only one type of risk that banks face. So interest rate risk can be hedged by matching the duration of the assets and liabilities, and this would have prevented the savings and loan crisis of the late 70s and early 80s. The yield curve at that point in time became inverted due to Paul Volcker fighting interest rates. The banks ended up in a situation, and the savings and loans in a far worse situation, where their assets, home mortgages, were paying a lower interest rate to the banks than they had to pay out to their depositors. They lost a lot of money and were bailed out by the taxpayers. So that was the crisis in the late 70s and early 80s. The most recent banking crisis, 2007 2008, was not caused by interest rate risk. It was instead caused by people defaulting on their home loans and simply not making payments. Yet another type of risk is liquidity risk. In most cases now, this isn't that big of an issue because banks can get liquidity from a central bank in the United States and also the European Central Bank. But this doesn't always work. An example would be Northern Rock, which never really was in a situation where they had more liabilities than assets, but they did have a run on their bank due to their depositors having concern about its ability to pay, and they did end up having to close and be shut down due to their inability to refinance their commercial paper and use that to pay off their depositors. I thank you for watching this video.